Hello and welcome to Trading 5 Talents. In today's video, I want to go over another interesting options play referred to as butterfly spreads. Now this one's a really cool one, so let's get into it. So butterfly spreads, what are they? Well, this is when you open a debit and a credit spread of the same type option, either a put or call, same width, and the same expiration. If you remember from a previous video when we talked about iron condors, that was opening a put credit spread and a call credit spread at the same time. Here what we're doing is we're opening a debit spread and a credit spread of the same type, either call or put. So this is once again a 4-leg or a 4-option play. So in contrast to the iron condor, we're going to be entering this butterfly spread for a net debit. And again, because it involves 2 spreads, there's going to be 4 options that we're going to be using. So the first one is a long call. And let's just say call for all of these examples, but it's a long call at a low strike price. And then it's 2 short calls at a middle strike price, and then another long call at a higher strike price. So the long positions are at the low and the high end, and then the short position is at the middle. So the longs are going to be the wings of the butterfly. The shorts are going to be the body of the butterfly. So if you're going to do a butterfly spread, again, you're either using all calls or you're using all puts. It'll have the same, risk to reward profile, the same profit loss graph, but you're just choosing one option type. So we're going to use Ford as our example, and this is the ticker symbol F. So once again, here we have the schematic of the butterfly setup. So your price line, left is the low price, right is the high price, the current share price, which is the vertical dotted line. And we're going to set up the wings of the butterfly. You can see the 2 long calls. So they're green because they're calls. They're on the long side of the price line, which is above the price line. So the 13 call and the 14 call, these are the long ones. So we're long or buying a call. And this is the 14 and the 13. It's denoted by these check marks right here. All right. Now, when we set up the body of the butterfly, we're going to have to sell 2 of this middle one right here. So the 13.5, and you can see that we're selling 2 of these. This is on the short side of the price line. That would be denoted here. It says 13.5 call, and it says we've already selected to sell this option. And so the way that this was set up was I just tapped on sell and then selected that one, tapped on buy, and then chose the 14 and the 13 calls as my long wings of the butterfly. Right, so those are the 3 that we're going to be choosing. However, from this screen on Robinhood, you can't choose 2 calls to sell. So what do? Once you click up to review, you would tap on the edit ratio. You can see circled here. And when you edit that ratio, you would select your body of your butterfly. So these are the 2 short calls or the sell calls, and you would just simply make that a 2. So here's our ratio of 1 to 2 to 1. 1 buy, 1 sell, 1 buy. And then once you do that, it will come up as a 3-option order. So this is the butterfly spread. And you see that we have circled that there are 2 of the short wings. Another way we can look at this butterfly spread, as we mentioned in the previous slide, you have a credit spread right here in which we are going short on this call that's closer to the money, and then we're buying this call that is further out of the money. So this would result in a credit. So here's your call credit spread. But we're doing 2 of these right here. So if we buy this one sell this one that's closer to the money, and then we buy this one that's further in the money for the call example, now this is a debit spread. So here we've got a call debit spread, and here we have a call credit spread. So it's a combination of these 2 spreads, but it shares that same short strike of 13.5 in this example. Now, when we combine these together, the call credit spread will give us 20 cents in premium, because you have your 64-cent credit minus the 44-cent purchase. So that's 20 cents in premium. And then we have our call debit spread, and that's going to cost us 29 cents because you purchased this 13 call for 93 cents and you sold this you sold this 13.5 for 64 cents. So we're paying more than what we're selling for. So that's going to be a net debit, and that's going to be 29 cents. So combining these together, you can see that a total of a 9-cent debit is paid. That is, it is only costing us $9 to enter into this butterfly spread. And obviously that's a very cheap option play. So let's look at the setup. So there's really only two that you can do. One is using calls, and the other one is using the put options. And so the setup is exactly the same. You have your short bodies right here. So you 2 puts or 2 calls. And we'll see in just a little bit, you would position the body to where you think the stock price is going to be at expiration. That's where you would position the body. So you can make this bullish. You can just put the body way over here, or you can make it bearish and you can put the body way over here. And then the wings are simply equidistant from the body. So if you're 1 strike out from the body on this side, then you would want to be 1 strike on this side. So equidistant from the body, and you sell 2 short options as the body of your butterfly spread. But regardless, whatever option choice you use, it's going to have the same risk profile. It's going to have the same profit and loss. You just either choose a call or you choose a put. It's completely up to you. So where does the butterfly spread profit? Where does it lose? Well, let's go back to our Ford example. And once again, just like all the other spreads that we've discussed, the profits and losses are going to be capped. And the max profit that you're going to receive on a butterfly spread is if the stock price equals the short price at expiration. So that's the best case scenario. Stock price is equivalent to the short body of your butterfly spread at expiration. And the amount of profit that you can make equals the width of the strikes minus the debit paid. So in our example, you can see we've got 13.5 to 14. That's 50 cent width, or 13.5 down to 13. Again, that's a 50 cent width. So 50 cents minus the debit that we paid, which was 9 cents. So 50 minus 9 is 41. That's going to be our max profit, 41 cents per share, or since this is an option play, it's $41. So that's our max profit. What's our max loss? Well, it's just the debit paid. It's just the amount of money that we use to enter the trade. So you have a really great risk-reward setup here. Only pay 9 cents and you can make potentially $41 off of this play. So obviously that's a really good risk to reward ratio. So let's head on over to Option Strat and we'll take a look at the butterfly spreads a little bit more closely. Okay, here we are on Option Strat. What I'm going to do is I'm going to hover over the build at the top, come down here to the neutral strategies, and we're going to just do the long call butterfly. So we want to use Ford, ticker symbol F as our example. And our short call was 13.5. From our example, our upper wing was 14 and our lower wing was 13. So you can see it just like this. Now here's our profit and loss diagram at expiration. Remember, green is profit, red is loss. At the time of making this video, you can see the debit is $6, so that's our max loss. That's as much as we can lose. Our profit is simply the width of the strikes, which is 50 cents, minus our debit, which was $6. So 50 minus 6 is 44. That's our max profit. Now that occurs if the stock price closes at our short strike, which was $13.50 at expiration. So trying to determine exactly where the stock is going to close at an expiration is nearly impossible. But again, this is only showing the potential profit. You don't have to be exactly right. You can be anywhere within this range in order to make your profit. And even if you're not correct, all you're losing is this, $6 in this example. So risking $6 to make $44, I would say that's pretty good. Okay, so that's the standard butterfly that we used as our example. So what happens if we, widen out these wings? So instead of 50 cents away from our short strikes, let's go $1 away from our short strikes. And you see that here. You see that our max loss is $29 and our max profit is $71. So again, it's still very favorable. Let's move it out $1.50 per side. And we've got this. Max loss is 63. Max profit is 87. So again, we're still doing pretty good. If we move it out to $2 on either side, max loss is $103. Our max profit is $97. So here we're getting closer to a 1-to-1 ratio of our risk to reward. But again, with this website, optionstrat.com, it's nice to be able to move these wings or move these options up or down and see which setup works best for you, for your risk tolerance, and for your trading account. Now, again, trying to determine exactly where a stock price is going to be at expiration, a week to a few weeks out, that's next to impossible. But it's still a great strategy to use if you've got limited funds. So you might consider that this is a really narrow profit range. I mean, you have to be exactly correct to get your max profit, which you do. If you wanted to widen this out a little bit, what you would probably want to do is you'd want to look into an iron condor, because that gives you a much broader profit range and it gives you a little bit of wiggle room if you don't anticipate the exact move of the stock. So if you want more information about the iron condor, then go ahead and check out my video on that. Right? So what are some of the advantages and disadvantages of the butterfly spread? So first of all, as we saw with the profit and loss graph, this is a great strategy for small accounts because the risk is so low. $4, $5, $6. Yes, you can risk a lot more than that depending on how you set it up, but overall, it's a very cheap play to put on. Favorable risk reward setup as well. We looked, just in the last example, you risk $4 to make $46. That would be a great risk reward if that, played out to max profit. So some of the disadvantages, though, is that there's going to be capped profits, just like any other type of spread. Longer fill times for your orders, because this is a 4-option strategy. So you have to have, 4 times as many as opposed to just one if you were playing a single option strategy, like, going long on a put or call or selling options. More commissions because you have more orders to fill. And also you have to be very specific in your where the stock is going to be at expiration, because any type of large move is going to have a really negative impact on this setup. So if you wanted to, and you didn't know exactly where the stock was going to go, but you were more confident in where it wouldn't go, then you could do a reverse butterfly spread or an inverse. Now, the profit is not going to be as great, but at least it gives you an idea. Some other types of options plays, if you don't know where something is going to go, but you know where it's not going to go, or at least are more confident about that, then that might be a play for you to consider. So that's it for butterfly spreads. If you found this video helpful, then go ahead and give it a thumbs up. If you have any questions about it or any of the other spread plays that we've mentioned recently, then go ahead and leave a comment down below or catch me on Twitter at Trading5Talents. In the meantime, if you want more videos like this, then go ahead and click on the subscribe button. Turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.